5 scandals, trillions of dollars in losses, and a financial system that would never be the same. From cooked books at billion-dollar corporations to the largest Ponzi scheme in history, these are the financial scandals that didn't just destroy companies. They rewrote the rules of money itself. And the one at number 1, it didn't just change the rules, it proved they were never real to begin with. Here's what you need to know before we count them down. Every scandal on this list did more than steal money. Each one exposed a fundamental flaw in the system, and each one triggered a wave of consequences that reshaped how the entire world handles money. Let's begin. Number 5. Enron. In the year 2000, Enron was the 7th largest corporation in the United States. Fortune magazine named it the most innovative company in America 6 years in a row. Its stock price peaked at $90.75 per share. Behind the scenes, executives led by Chief Executive Officer Jeffrey Skilling and Chief Financial Officer Andrew Fastow were hiding billions in debt through a web of off-the-books shell companies. They used a technique called mark-to-market accounting to report profits that had not actually been earned yet. By the time internal whistleblower Sharon Watkins warned Chief Executive Officer Kenneth Lay that the company could implode in a wave of accounting scandals, it was already too late. In December 2001, Enron filed for what was then the largest bankruptcy in American history. The stock price collapsed to 26 cents. 25,000 employees lost their jobs. Investors lost an estimated $74 billion. And Arthur Andersen, one of the 5 largest accounting firms on the planet, was destroyed for helping cover it up. Skilling was sentenced to over 14 years in prison. Lay was convicted but died before sentencing. But Enron's real legacy was not the punishment. It was the proof that even America's most celebrated corporations could be rotten to the core. Number 4. WorldCom. Just 7 months after Enron's collapse, an even bigger bombshell dropped. WorldCom, the 2nd largest long-distance telecom company in the United States, revealed that it had been inflating its earnings for years. Chief Executive Officer Bernard Ebbers and Chief Financial Officer Scott Sullivan had been reclassifying billions of dollars in operating expenses as capital investments to make the company look profitable when it was not. An internal auditor named Cynthia Cooper discovered the fraud and reported it to the board. The total damage? WorldCom had overstated its assets by more than $11 billion. When it filed for bankruptcy in July 2002, it listed $107 billion in assets and $41 billion in debt, making it the largest bankruptcy filing in American history, surpassing Enron by a wide margin. Investors lost over $180 billion. 17,000 employees lost their jobs. And the 1-2 punch of Enron and WorldCom together forced Congress to act. The result was the Sarbanes-Oxley Act of 2002, which completely overhauled how public companies report their finances. For the first time, chief executive officers and chief financial officers were personally liable for the accuracy of their financial statements. Ebbers was sentenced to 25 years in prison. The age of unchecked corporate accounting was officially over. Number 3. Bernie Madoff. For decades, Bernie Madoff was one of the most respected names on Wall Street. He served as chairman of the NASDAQ stock exchange. Wealthy investors, charities, and even international banks trusted him with their life savings. His fund reported steady annual returns of about 10% year after year in up markets and down. It was too good to be true, and it was. In December 2008, Madoff confessed to his sons that his entire wealth management business was a Ponzi scheme. He had never invested a single dollar. Instead, he used money from new investors to pay returns to earlier ones. The scheme had been running for at least 20 years. Total claimed losses reached $65 billion, though the actual money deposited by investors was closer to $18 billion. More than 40,000 victims across 127 countries were affected. Charities were wiped out. Retirees lost everything. The SEC had been warned about Madoff multiple times, including a detailed report in 2005 titled, "The World's Largest Hedge Fund is a Fraud," and they did nothing. Madoff was sentenced to 150 years in prison, where he died in 2021. A court-appointed trustee eventually recovered nearly $15 billion, and a government victim fund returned over $4 billion more. But for thousands of people, the damage could never be undone. Number 2. The 2008 financial crisis. This was not one company cooking its books. This was the entire system failing at once. Throughout the early 2000s, banks began handing out mortgages to millions of borrowers who could not afford them. These risky subprime loans were bundled into complex financial products called mortgage-backed securities and sold to investors worldwide. Rating agencies stamped them as safe investments. Everyone was making money until home prices started falling in 2006. Borrowers defaulted. The mortgage-backed securities became worthless. The banks that held trillions in these toxic assets started collapsing. Bear Stearns was the first to fall. Then Lehman Brothers filed the largest bankruptcy in American history, with over $600 billion in assets. The government stepped in with a $700 billion bailout through the Troubled Asset Relief Program. But the damage was done. The S&P 500 fell 57%. American households lost approximately $17 trillion in wealth. Nearly 8 million jobs vanished. Home prices dropped over 20% nationwide, and millions of families lost their homes. The poverty rate climbed from 12.5% to over 15%. And here is the detail that still infuriates people today. Only one American banker went to prison. One. Out of an industry that crashed the global economy. The executives who drove the crisis walked away with golden parachutes, while ordinary people lost everything. Number 1. FTX. In January 2022, FTX was the third largest cryptocurrency exchange in the world, valued at $32 billion. Its founder, Sam Bankman-Fried, was on the cover of magazines, testifying before Congress, and donating millions to political campaigns. He positioned himself as the responsible face of crypto. Then, in November 2022, a leaked balance sheet revealed that Alameda Research, a trading firm also run by Bankman-Fried, was propped up by a token that FTX itself had created. When customers rushed to withdraw their funds, an $8 billion hole appeared. FTX had been secretly funneling customer deposits to Alameda Research to cover its losses and risky bets. More than 1 million users could not access their money. The collapse took just 10 days, from the first report to the bankruptcy filing. The man brought in to clean up the mess was John Ray III, the same restructuring expert who had handled the liquidation of Enron. He said he had never seen such a complete failure of corporate controls. Bankman-Fried was convicted on 7 counts of fraud and conspiracy in November 2023 and sentenced to 25 years in federal prison. FTX became the defining scandal of the crypto era and proof that even in a brand new financial system, the oldest trick in the book still works. Take other people's money, lie about what you are doing with it, and hope nobody checks. 5 scandals. 5 moments that shattered trust in the financial system. And the uncomfortable truth? Each one happened because the people who were supposed to be watching either looked the other way or were in on it. If this countdown opened your eyes to how the financial system really works, subscribe for more stories about the money, the power, and the scandals they don't want you to know about.